Today is Tuesday. I am super excited for tomorrow to go live with my good friend and partner, Dan Frio of the Rate Update with Dan Frio. Please subscribe to our YouTube so you can see when we go live. It's tomorrow, 8 p.m. Eastern Time. We will be talking about how to prepare for repayment. Now that we officially know we're getting kicked back into repayment as of this August. First payments are actually due October. So we will also be going over how to prepare for that, as well as any live Q&A from anyone that comes to his that comes to our live tomorrow. And in order to prep for that, I've been asked by several times by several partners on giving an overview of the student loan plan options that the federal government offers. So today's video will be a review of the different types of repayment plans that the federal government offers, okay? So I'm gonna reduce the size of my face here so that you could see, I just drew this out super briefly. I'm gonna move my face, actually, let me just make my face smaller so that we can see the different plans, okay? And I'm gonna probably move my face around. So first and foremost, there's the standard repayment plan. The standard repayment plan is the plan that every borrower is put into as soon as they enter into the student loan plans, okay? The standard plan is a 10-year, fully amortized. That means you pay off every dime of interest over the lifetime of your loan over 10 years. So based on your interest rate and your loan term length, which is 120 payments, 10 years, let's say you borrowed $50,000 and your interest rate, it's about $500 a month. By the end of the 10 years, you'll have paid off everything you borrowed plus the interest, okay? That is the standard plan. I'm going to explain now the extended repayment. So I put, this is the length of time of payback, by the way, the x-axis. The y is the amount you pay. So let's say you pay $500. Now let's say you're going to 20 years. You're gonna have a little more interest over 20 years. It's not gonna cut your payment quite in half, but it's gonna be lower, but you're gonna pay off over 20 years, and you're going to pay more interest over those 20 years, but it's going to lower your payment. So this is what extended repayment means. It means you're just going to pay more interest over the 20 years. That's extended repayment. It's kind of like if you extend your mortgage from 15 years to 30 years, right? If you had a 15-year mortgage and you extended to 30, it would increase the ultimate amount of interest you pay back, but it would lower your monthly payment. That's the same concept with student loans, right? The government offers that, okay, for student loans, especially higher student loan balances, right? Then there's graduated repayment. This is like an adjustable rate mortgage to define some comparisons here. But basically, these plans start out like basically it's over 10 years. You can even get extended graduated, which goes for more than 10 years. But the idea is that you start out with a lower payment for 2 years, then it jumps. So you paid for 2 years, so year 2 years and to 4 years you pay a higher amount. Then 4 to 6 years you pay another higher amount. 6 to 8 years you pay another higher amount, and then finally 8 to 10 years you pay a higher amount. And over the 10 years you end up paying back similar amount of interest to the standard plan. You just start at it's slightly more interest because you're delaying the beginning interest, so it's going to be slightly more interest than the standard plan. But the reason I'm not a fan of these is because what ends up happening with so many borrowers is that by year 4 or year 6 or year 8, it just is no longer affordable because as time goes by, borrowers tend to have increasing financial responsibility like having a child or wanting to buy a home. And so graduated repayment, from what we've seen, is not very good for borrowers because they just, by the middle to end of their plan, they just can't afford to make the payment, and they end up going into another payment plan, which ends up just extending the time they have to pay back as well as the interest. So we don't recommend that. In fact, our software at LoanSense does not include graduated repayment plans, but you can go into them. So just FYI. The ones that we often get people into and that we advocate for is the income-driven plans. And there's multiple different income-driven plans, but essentially, and people often ask me, well, how about loan consolidation or refinance? It's not the same thing. Consolidation is the act of putting your loans into a group of loans that can be enrolled into income-driven. The act of consolidation does not reduce your interest. It does not reduce the total amount you pay back. So let's not confuse the act of getting qualified for loan forgiveness versus what the actual student loan plans are, right? So I just wanted to clarify that real quick. So income-driven plans, what it does is the year of paybacks depend on your employer. So if you're a nonprofit employer, you're going to pay back over 10 years. If you're a for-profit employer, it depends on what plan type you enroll in. If you have undergrad and grad school or Parent Plus loans, that's also going to dictate the length of payback, okay? So I cannot give an absolute answer. Let's say you're undergrad, private employer, you're likely to pay back 20 years. If you're grad school, if you have grad school and public servant, then likely 10 years, right? So if you're public servant, which means you work for government, nonprofit, most of the time 10 years, okay? And essentially what it does is every year you submit your income and you verify and certify your employer, and it makes the amount most of the time lower than the standard repayment amount. And what's also great about it is if you lose your job and have a period where you don't work, you can get near $0 payments or $0 payments depending on your income. So to get back to this, so income driven, right? It protects against income shocks. And the best part is if you see, excuse me, the areas underneath the curve is the ultimate amount you end up paying back, right? Like it's a concept you learn in calculus. Under the curve, the total area under the curve is the payback amount. So here you see this person's clearly going to pay back less, and the remainder that's not paid back on income-driven plans are forgiven. In the event the person has a huge income spike, a lot of plans will cap the repayment amount at the 10-year repayment amount. If you go into Revise Pay As You Earn, it does not cap it, but that's also a plan that doesn't require hardship, right? So I can explain more of those terms later, but hardship just, if you don't earn enough to pay back the full amount, that's what I mean by hardship. More than 50% of graduates right now, of people that come out, even if you don't graduate, have more debt than income, so they meet the hardship requirement, okay? So just to go over that. So these are the 4 plans. There's also, for example, you can call your servicer and go into loan forbearance. That is not a plan type, but a lot of people did that for years and years and never made a payment. We highly do not recommend that. It's better to go into an income-driven plan where you can get as low as $0 payments and it still counts as a payment. So I just want to say that because servicers for so many years recommended forbearance like it's a plan type, but it's not a plan type and you should not go into forbearance ever. You should find one of these options. So this is the overview of all the different student loan repayment plans. There are some really eccentric plans like a combination, or if you got out of default, they kind of make a combination of these plans. But basically, those are one-off plans that are not as common. So these are the 4 most common loan type plans. And essentially, we like to recommend, again, the plans that qualify people for loan forgiveness. The downside of the income-driven plan is that you have to file your income tax. You have to file your paperwork annually in order to certify your income. And if you do not do that, then it kicks you back into standard and you experience what's called interest capitalization, which just means all the interest you did not pay gets added on top of the principal, and now your interest is accumulating at a higher rate because it's accumulating not just on that original principal, but it's accumulating interest plus principal. So keep that in mind. There are great advantages to income-driven, but there are also disadvantages if you're not going to stay on top of it. I want to point out one other thing, because people ask me all the time, well, what if you earn more income, right? What happens on the income-driven plan? This is a person that earns relatively low, right? So let's say someone earns, they start here because they earn less, but they accelerate in their career and they start earning more. They're between jobs. They file for $0 payment, so they go like that for a bit. Then they go back up. It caps at the 10-year mark, right? So it hits the cap, and then they stay at the cap for a while. They are between jobs. They can refile. They hit 0 again. So they go like this. They earn more. They go like this, right? So even if it's like this, then they get their loans forgiven. Every time they're between jobs, they can file into the plan, which is completely legal. And even if they pay back near what they pay back on the fully standard plan, the times that they can't pay, they're protected. And they can also get mortgages. They can also get other financial products, I say mortgage specifically, at the times that they have a lower income, and it will reflect a lower DTI as well. So I just want to name some of the advantages, right? So even if somebody has a higher payment, you see, even if they earn a ton more money, it never goes like way high or something like that, right? So they're always protected, and that's what happens in the scenario that your income goes up. But most Americans don't have such huge income increases. Our software accounts for about a 3% annual increase. And so I just want to put that out there. We give completely free analyses for borrowers at myloansense.com, app.myloansense.com. We also help mortgage lenders understand the implication of getting into an income-driven plan on their mortgage. Lenders can always sign up at myloansense.com/lender for our weekly training call, and we can help you analyze the loans coming into your pipeline to see who we can reduce, pull through more loans, and pull through loans at a higher affordability. Let's together help everybody get prepared to enter repayment and to fully know and understand their loan options. I cannot wait to come to you with next week's update. Until then, if this information was helpful, please subscribe, please like, and I will see you next week.